Arnold mentioned some of the other positive things, and he talked about the benefits that are coming from natural gas fracking. One is we're producing tremendous amounts of natural gas, which we can export to other countries, so that's an export-driven benefit that the U.S. has. But there's additional competitive advantages that the United States has relative to its international competitors that had been headwinds that are now starting to become tailwinds. For example, over the last decade, China has been a tremendous force in terms of adding low-cost labor to the market. And that has hurt, and it's been a very big part of our unemployment, structural unemployment problems. But as we see now, that labor arbitrage is being closed. And there's companies that are now starting to bring back manufacturing to the UK, to the US, which is an indication that that labor arbitrage is going away. So the U.S. productivity gains that we're making are now starting to change those that were headwinds into tailwinds. And much like the 90s, when the U.S. went into recession first and then recovered, there was this continual argument that we were going to have double-dip recessions, but we never did. We had rolling recessions, 3 sectors, but never that double dip that everybody's worried about as the U.S. separated from the rest of the world. These positive impacts, the productivity gains that we're having, has that potential that the U.S. can then start to become competitively advantaged and gain share from the rest of the world.
Arnie, let me add one thing, too, about Jim's comment on the disciplined process of bracketing the price on a bad news circumstance and a good news circumstance. We don't have to make opinion about this. We have some actual, real, recent experience in this. Last summer and fall, that everyone probably remembers, was a quarter that was nearly as bad as the fourth quarter of 2008. Right. The market in small cap world was down 23%, and large cap world was down 17 or 19%. And during that time, knowing that we're tracking all the companies that we track, we found that as we did those brackets, very few of those companies in this very bad environment actually got below our worst case. I think it was only 10% of the portfolio, and that included ones that were just barely below worst case. So in fact, we actually have the systems and the tracking and the disciplines to know just recently about how things can get in the headlines and how it actually translates to the portfolio. The outcomes were very good.
Yes, I remember that in our all-cap portfolio, on the October 3rd bottom, the average portfolio was 11% from its worst case. Mm-hmm. That gave us a lot of confidence to know that we factored in all the things that Jim was talking about, the euro crises, the tax increases, the Obamacare. All of these factors were factored into our worst case, and when the market came down, we got within 11% of our worst case. At that time, one of the most prominent economic consulting firm was predicting that there was going to be a recession. And I remember many clients calling us and saying, look, the market is coming way down. They're forecasting a recession. Why don't you sell some stocks? Well, we heard that, but then we looked at our valuation, said they're only 11% from the worst thing that could ever happen. This is not a time to sell. Now, this consulting firm still is predicting that recession, and they may very well be right. We do not disagree with them. The bottom line is that since that day, the market is up 20%. So if we would have reacted to that news, instead of our evaluations, we would have sold the stocks, and we would have missed out on a 20% move. Now, irrespective of whether this person turns out to be right or wrong, you can see that you can't always buy and sell stocks on the news. You have to go by the evaluation. And the closer it gets to the worst case, the worse the news is, because that's what it's predicting. So recently, many of our stocks have moved out of our worst case area, and they've moved to the sell point. And that's why we've been raising cash, not because it's a prediction of what we think is going to happen, but because these stocks actually reach the evaluation. So I can't emphasize enough the point that Jim made, is if we really factor in all of these problems into evaluation, we have the worst case and the best case, and then we move the discipline in that area. That is the best way to navigate these stormy seas.